you drew a straight line from Michigan to Texas, you would see our map of assets clustered
I
along that
see.
line going down. That's where, again, the heavy concentration is for a lot of manufacturing companies like this. These are generally business to business.
Welcome everyone to today's Hero Capital Raising Show. I'm your host Tim Mai. Today I have a good friend, an amazing capital raiser on the line with us, and Mr. Drew Wahlgren. I got to meet Drew through a mastermind with Javier Hinojo, he's another great friend who got me started in this business, in this syndication business a couple years ago. And yeah, so Drew has been investing in real estate since 2011, Capital Partners in 2019, and has been focusing on the industrial warehouses, manufacture type assets. And so the organization, Mac Capital Partners, has acquired over $1.1 billion in assets. They currently have over 950 million AUM right now. I know that as a company, I believe you guys have raised over 300 million. Drew himself has raised over 80 of those millions. And so let's give Drew a big welcome, y'all. Woo-hoo. Okay, Zoom
Thanks,
welcome,
Tim.
Zoom
Appreciate it.
welcome. Okay. Yeah, Drew, share with us, what I'd love to learn a little bit more about what had you decided to get into this real estate space, and then also to what had got into the industrial warehouses niche of the real estate.
Good question. So a little my backstory. You mentioned starting in 2011. Bought my first house then. It was not an investment property. It was my primary home, but I had, full intention. It was the ugliest house on the block. And I didn't really have much money, frankly. So got a first-time home buyer's loan, put very little down. And this is just one of those cool stories that real estate can create, is putting a very small amount of money down and then just getting to work, right? I did a ton of work on that first house, sold it for a nice profit, and did it several more times, and really flipping houses. And I really got to that point after three, four of these where you go, okay, this is the point where I buy another house and I keep this one and rent it out. I have the capital to do that now. Decision time. And at the time, I have an older brother who had been working for a firm in the Bay Area, raising capital and partnering with a handful of trusted operators. And so he had been exposing me to this for a while. We talk about commercial real estate. And basically, I said, okay, what do you got available? I'm taking your advice on this because I didn't have much experience in the space. So I started investing as an LP, and we continue to have those conversations over beers and dinners and everything else. And that's just that repeat conversations, and learning the inner workings from the GP side from him was really cool. And to say, hey, this is how we make money. This is how we can restructure a deal. This is how we can refinance out investors or sell, and what the splits look like, and all that really beginner kind of stuff. So I was investing as an LP, and one of those operators that his group partnered with was Mag Capital Partners. And so I got to know the principals there. And fast forward a bit to 2019, my brother and I both, for just about 10 minutes, had our own firm and raised capital for only one deal in partnership with Mag Capital Partners. And we had a nice meeting where we said, hey, what are we doing here? This works so well, but it's complex. Why not bring the Wahlgren brothers under the umbrella of Mag Capital Partners? And it was a great fit because, frankly, this group, Mag Capital Partners, and the principals there had a ton of commercial real estate experience. They're fantastic operators, but they were really starting to bottleneck at the capital raising side. So we came on board and essentially built out vertically integrated capital raising in-house so that we could truly be a one-stop shop for our investors without co-GPs. And I really enjoy that ability to be close to the operations side as well as our investors. And that role for me has evolved over time, where now I'm raising capital equity from investors, debt as well. We do private debt investments, but also working on the bank debt side. So senior financing on properties. So it's a really fun way to kind of line up both sides of the capital stack and stay as close to ground level as on acquisitions that are coming in as possible, because frankly, that's just a huge part of the business, is just really all the negotiations on the front end, and really being able to, when we finally launch a deal and start raising capital from our investor group, I love having been in the trenches on the deal for 3 months. at that point, maybe longer, sometimes 6 months. And you really can give a lot more of the story to your investors just because you've been living and breathing an acquisition of a piece of real estate for a long time. So anyway, that's the backstory on how I got here today.
I love it. Yeah, it's interesting to hear that you guys started out raising for the deal and then ended up partnering up with the operator to ongoingly raise for them. It's actually a conversation I've been thinking a lot about lately because I through my funds, I've raised for a number of operators and been thinking about what it would look like to just take on the entire capital raise for maybe one or two operators and just go all in on that. So it's interesting that your model is that way. Now you mentioned a term vertically integrated regarding capital raising. What exactly does that mean?
Yeah, what it means to me at least is that we're raising capital in-house versus having that co-GP relationship, right? No problem with a co-GP relationship, but having again, for those same reasons I talked about, having your investor relations folks being a little bit closer to the deal because they're on the operations team as well is a benefit, certainly. But what's the other side of the coin, right? As an operator, you can focus on operations. If you're,
Mm,
hey, I don't need to worry about investors questions about K1s and X, Y, and Z. That's my partner's responsibility. So yeah, for us, we're vertically integrated completely in that we have in-house credit analysis, we have in-house accounting. We really, the only third parties we use from a team standpoint is legal. There's some benefit to going to third party legal and having them being independent. Usually they're a little bit closer to the industry and what's going on in the world, if that's the case, versus in a little silo of your company. Environmental consultants and a couple other kind of roles like that that we bring in every transaction. But for outside of that, 3, 4 people, everything else is done in-house, employees of the team.
gotcha. Okay. Before we dig deeper into, because I love to learn the capital raising systems that you implemented at Mag. But before we go into that, I'd like for you to share the business model. Like, what's the type of properties you go after, the type of tenants that you go after? Give us an overview of that.
Yeah, we're a commercial real estate investment shop that's a few years ago even expanded into private equity, but all really focused on industrial. So on the real estate side, which is 90% of the assets that we manage is real estate, and the vast majority of that's single tenant, triple net lease industrial real estate. So we invest across the country, and a little benefit of having long-term triple net leases is it's not management heavy. So we don't have to have boots on the ground in each one of these markets. So we're fairly agnostic when we look at markets, and then we do our due diligence on the
Mm,
market after starting to review the deal versus targeting the Southeast, for instance, right? But where we see, speaking of geography, more opportunities is for us because we have a lot of manufacturing tenants in the Midwest, the Southeast, I just mentioned, Georgia, Tennessee, Alabama have just been, I feel like there's more and more manufacturing operations there, more and more deals that we see out there. But really, across the nation, I really, if you drew a straight line from Michigan to Texas, you would see our map of assets clustered
I
along that
see.
line going down. That's where, again, the heavy concentration is for a lot of manufacturing companies like this. These are generally business to business sales of usually widgets, basically parts that go into an assembly somewhere else. And that's a generalization. We have some food processing, food manufacturing companies as well. But yeah, these aren't Los Angeles based manufacturing companies, right? Because generally in the world of widgets and parts, they're a little bit more price sensitive. They have to protect their margins, so they'll operate in an hour outside of Chicago, Cedar Rapids, Iowa, 40 minutes outside of Atlanta, right? They're in the outskirts where they can find labor for cheaper. They have access to transportation. And again, protecting that overhead, or I should say, targeting a lower overhead to protect that margin. So it's too high cost of doing business unless you're a chip manufacturer or Tesla or someone like that to be central Austin, Texas, right? It's just the cost is too high there. Yeah, we see these opportunities out there. But I'll add just really quickly our specialty or sale-leaseback transactions. So in that case, many times we're following behind private equity acquisitions of these businesses. And following that, they'll want to spin off the real estate in a sale-leaseback transaction. So we're buying the real estate from them and simultaneously executing usually a 20-year absolute triple net lease to the
Mm,
tenant at closing. So for us, we go, look, we have a lot of predictable fixed inputs here. I can see my NOI from day one. I can see it at year 5, 10, anywhere along the way because it's all baked into that cake and I have no expenses due to the term of that lease. So pairing that with fixed rate financing and of course our private equity investors alongside us, there's a really predictable cash on cash yield. So what we're, building and engineering there is a very predictable cash flow model with real estate upside, right? Appreciation still being passed along to investors.
see, very interesting. I'm just curious, why do these private equity that acquire the business want to break out the real estate piece of it?
Yeah, good question. It's interesting. As we're all real estate investors here, I think most of us are, and you go, why would they want to own the real estate? Many of these guys run a fund just like a real estate firm, right? Private equity real estate, and then you have private equity firms over here. Hey, we have a fund, we have pension fund money, sovereign wealth, whatever it is. Here's our fund, and per our fund docs, we are to invest in businesses, not real estate, right?
Uh,
So sometimes there's a bit of a conflict there to say, hey, we're maybe they're allowed to own up to 15% in real estate, right? They'll have some limitations there. But a
I
lot of times
see.
for them, they go, look, this is lowering our cost of acquisition if they're doing it simultaneous. Sometimes, hey, we want you to close on the real estate as we're closing on the operating company. This is a 20 million, $50 million transaction, but there's 15 million of that is tied up in this real estate. We don't want to tie up as much capital in the real estate, right? We see as a private equity group a higher rate of return on our investments in businesses, right? And that can be said, right? It carries a higher risk element. It's just a different investment, but you could see why they wouldn't want to tie up their capital. They're in the business of investing in manufacturing companies, let's say. So that can be one reason, but sometimes it could be years later, and you go, okay, they've owned the real estate so long, 4 years now, and now they're selling it. Why? And they're using it as a financing alternative to go into a bank and getting senior debt. And part of that is because the way the accounting rules are, you go get a $10 million loan, and that's going to come with covenants first from the bank and many pages of them, but it's also going to put leverage on your balance sheet. So here they look at a sale leaseback and they say, look, I can access the $10 million in equity that's trapped in this real estate. I'll
Mm,
pull that out. It's not free. It comes with the obligation of rent, but rent does not, according to modern day GAAP accounting rules, is a footnote on the balance sheet. So it doesn't affect some of those metrics that they may already have senior debt that says, hey, you cannot exceed X debt to EBITDA ratio, right? So some of these things they have to be sensitive to, and they can
I
say, hey,
see.
we can access some very flexible capital here and not affect our debt ratios. So for us,
That's
obviously, we want to look really closely at, hey, can you afford the rent, right? At the end of the day, or are you leveraging yourself a bit too high, right? EBITDA is 1.5 times rent. That's not great, right? That's a pretty tight margin you're looking at there. If you're saying, hey, your EBITDA is just barely covering your rent obligation, and we can get into that more, but credit analysis and evaluating the strength of this tenant is paramount in this kind of investment strategy.
fascinating. I love this whole war of commercial real estate. It's like there's so many different ways to structure deals and so many different types of deals. It's mind blowing. Let's talk about the capital raising side. So you and your brother came in to an existing operations, and I'd love to hear what marketing systems or what capital raising systems did you first implement it into the business, and then give us an evolution of how that has been going. Yeah, the evolution of the systems that you have implemented.
Yeah, I wish I could tell you we had SOPs, standard operating procedures, back in 2019. No, it was a little bit looser than that. It was just my brother and I, Neil and I, doing this. And at the time, we were syndicating individual deals. And fast forward to 2022, we syndicate individual deals, but we also have a flagship fund that we roll up our sort of
Mm,
primary investment strategy, those assets that I just talked about, sale leasebacks, we roll them up into a fund level. So obviously you treat those a little different. But at the time, yeah, we'd get into contract on a property And there's a lot of work to do, a lot of legal PPMs, as everyone here I think knows there's a lot of professionals here in the room. But um, yeah, you'd need to get through all that legal and finally launch a deal. We had deals where, hey, we need to raise this thing in 2 weeks. We're closing in 2 weeks. So it always felt, man, the pressure's on, get the capital in because we have a closing coming up. And so really it was a matter of using the syndication software that's out there. Back then we were using Juniper Square, and we would basically put together a communication that was pretty robust and included all the details of the deal. This isn't reinventing the wheel, right? Most I see these every day in my inbox, right? Structure communication, send it out, and then frankly at the time, jump on the phone and start calling
Mhm.
people and prioritizing your regular investors first, and then of course going down the line because you never have enough time to call everyone, at least from my experience and at least from the size of our investor group. But really just making sure that no one's missing an email and making sure they have your attention or you have their attention, excuse me. So
Right.
yeah, it wasn't anything especially unique, but that was really the start and how we did things. And it's fun sometimes for me to look back. I think the first deal, it took us 2 months to raise $2 million. And it felt like a slog. And the deal was great, but we just really hadn't expanded that capital raising operation yet. Our investor group wasn't that large. And frankly, we have 5 more years of experience as a team since then. Still, as a firm, we were formed in 2015, and the principals have decades of experience before that. But we're talking about a relatively young company. Fast forward, I think our first fund, probably at the peak of capital out there being invested, middle to late 2022, and we raised $60 million in about 2.5 months. So
Wow.
huge difference there, timing. And again, the markets matter here, right? Because are we going to raise $60 million in 2 months today? Probably not. It's a different environment.
Gotcha. Yeah, but that's still phenomenal. So how have you been expanding your investor database since you came into the company? What are some of your ways that you did to grow the investor base?
Yeah, I try to be creative. I don't mind even sharing a couple kind of fun, unique strategies I have here, but where the vast majority of new investors is always going to come from referrals. So I always tell people who are raising capital, hey, don't be afraid to ask for a referral. And sometimes it's a matter of enticing that person to bring in a referral. And it might just be dinner. Hey, I'm going to be in town, or hey, I got some time next week. You've been with us a couple deals now. I'm sure other real estate investors, hey, do you have a group that would be interested in hanging out, talking about real estate? We could share what we do. I could learn about what they like.
Mm,
And really just a way to, people don't think to go out of their way, especially if they're busy. There are a lot of these passive real estate investors are busy professionals. They don't have time to think about this. And you find the ones that do have time to think about it because they are the ones that are sending you a referral, right? Hey, I was talking to my cousin
mm,
about what I invested with you guys. He's interested. That kind of thing is fantastic. But a lot of people just don't have that network of people that they're always having those conversations with, or they just don't think to start making those connections. So it's good to get in front of people, and I don't think there's anything too brash about asking someone, hey, would you like to get together with some of your investor crew and we can meet and chat? And most people enjoy that versus, hey, send me names and phone numbers of who you think would be interested, right? Just you're bringing something to the table, and I think that's the best way to draw out referrals is, hey, bring something to the table, give them a reason to bring their friends and family. And oftentimes that's a in-person physical event. We did one recently, a waste management open in Phoenix was a few weeks ago.
mm.
We got a suite there. It took us 2 years, I think, to finally be able to get a suite there. And we got it. And it was great. We invited all of our Arizona investors and we specifically asked them, hey, bring your friends and family. They're absolutely invited who are interested in real estate. And it was great. Met a ton of new people. Not a cheap event, but it was fun to see that happen and familiar faces bringing their family and friends alongside.
Gotcha. Do you have, so I understand you have those events that you do on occasions. Do you have events that you do on a monthly basis, a quarterly basis?
Yeah, good question. It's always evolving, right? So I'm not going to pretend we've had the exact same strategy. We're always trying new things. At one point, we were doing more occasional events that were a little bit higher in price, frankly, a little more formal, private room, catering, And we've been trying something different. Really, there's a team now on the investor relations side, right? There's five of us, right? So
Mm,
we're basically asking everyone in our team who's spread out around the country in different markets, and that's by design. Hey, go set up a happy hour in your market. We'll invite all the people in that market to it. And it's a lot less formal. And frankly, it's, hey, we're going to be here at this place for 3 hours, have a little space. It might not be private, get a bunch of drinks and appetizers. Come again, bring friends and family. Come on by. We'd love to chat with you, hear what's on your mind, any feedback. We can tell you more about upcoming investment opportunities. And for some people, it's the proof of life, right? It's funny to me at least. People would go, do these people even exist? And to them, we're saying, hey, on a more
mm,
regular basis, we're going to be here available to you. You don't have to come, right? But if you want to come by and chat, we're here and available. So I like that. But honestly, I was doing it once a month for a while, and I'm in DFW here in the market. So I'm not traveling around. I'm just making myself available to the investors that we have here. And frankly, after about 4 months, I realized, okay, this is too much. It's You start to see that attendance dwindle over time because people are like, oh, he's going to be here next month or last month. So maybe every 2 to 3 months is better. But again, it's always an evolving process where you're learning these kind of lessons and going, okay, what makes sense? How often should I be out there? Maybe we'll go back to once every 6 or 12 months having a larger, more formal event and bring a draw. At one point we have a relationship with Apollo Ono, the famous speed skater. He's actually an LP in one of our deals with us and goes way back with the principal. And we had him, he does a lot of corporate speaking. So we had him speak at this hall that's at our office in Dallas. And it was great. It was a great draw point, right? Hey, I'm going to come and I'm going to see Apollo Ono and I'm going to interact with the MAG team. And that's, again, bringing something of value is a lot better in my opinion, but may cost some expenses there, right? But
okay.
what are you bringing of value? What are you bringing to that event versus, hey, come get a couple drinks and an appetizer? A lot of times people crave that sort of center point of an event to come out to.
I see. I like that. What about LinkedIn? Do you use that for prospecting at all?
A little bit. I think it's good background information. If you have a lead referral, something, just seeing their face, seeing where they live, what they do. Sometimes that's just great background. I used to use it a bit more and it was a lot more successful probably 3, 4, 5 years ago. And now it's just flooded. I get messages half a dozen every day. So I imagine a lot of folks that are doctors, tech engineers, people that a lot of in investor relations folks will be targeting. So I can't
Mm,
imagine what they're getting. So I think it's become a bit saturated. But again,
hmm.
just to see some sort of useful information to review before a meeting or a call, I think is nice. Once in a while, you meet someone and whatever happens, there's just some miscommunication and no one has each other's emails or phone numbers. That goes a long way, right? Hey, just following up. Great to meet you. Can you share your email address? We'll take the conversation there and I'll share whatever it is we talked about.
I see.
But
So, out of all the different marketing channels and strategies, if you have to pick one that's your favorite, which one would you say that would be?
Oh gosh. Okay, I'll give you one. I won't say it's my most successful, but it's something newer that I thought of, and I thought it was it's working so far, but I haven't had the most success. So if you have a CoStar account, you can go in there and there's a huge amount of data there in the commercial real estate. We have a CoStar account. It's not cheap if you don't have one. It could be leave you shell shocked if you see the pricing on a subscription. But again, from an operator's team, it makes a lot of sense, right? Due diligence, market data. And you think, how can I benefit from that on the investor relations side from capital raising? And what I started to realize is, hey, I can really whittle this down and look at buyers on record of commercial real estate of any kind of asset class. You know, how I specifically did it. And I actually did a little more this morning, actually, and I've been periodically touching base with it. But I just looked at the Dallas Fort Worth market. I looked at sales of assets, commercial real estate. I whittled that down to industrial. And then I looked at pricing between 1 and 5 million. And my strategy and thought was, hey, if these guys are out there buying real estate between 1 and 5 million, this is someone who has some capital to deploy. They like real estate. They have some kind of attraction to industrial real estate. So imagine that you've created this
Mm,
criteria that's really strong. And they may be at the sort of downside of this is you're talking to someone who's an active investor and they may have
Yep.
zero interest in being a passive investor. And that's fine. Frankly, I've had some amazing conversations with folks who are never going to invest with us. But I just, even when it said, hey, this isn't a fit, you have that genuine interest on both sides. I want to know what they're doing with industrial real estate, what their strategy is. They want to hear about ours. And those relationships lead to referrals. Just having those conversations oftentimes leads to many more connections. So it's been really fun. Again, for us as an industrial operator, it makes a lot of sense. If you're the capacity of, hey, I'm raising capital and co-sponsoring deals, multifamily all across the country, it might still be fine, right? Hey, I'm going to look at buyers on record for multifamily between, yeah, 1 and 5 million or whatever that looks like. And so I chose that amount because frankly, there's not a lot of industrial smaller than $1 million, but you get too high and obviously that this is not going to be, this is going to be corporate or family offices maybe. And that might still be a good partnership there, of course, too. But I was trying to find individuals and I say, look, there's a lot of individuals buying in this range and they have capital to put down between 500 and $2 million. That's a great kind of criteria. I'd
Right.
love to hear if anyone else has success doing that. But I thought it was creative and I've had several investors join us and a lot more connections that have come out of that.
I love it. It is very creative. I love it. I've seen a DST company did something not exactly like that, but something similar to where they were targeting baby boomers that have rental properties. And yeah, so they would mail to them, market to them, getting them to an investor dinner and converting them from there. But yeah, as you were talking, your strategy there, we can tweak that for for a lot of different asset types, right? So,
Right.
a lot of people on here do multifamily, so you can do the same thing for multifamily sellers or buyers, or yeah, like after they've owned an asset for X number of years, you can estimate that they might be getting ready to exit that property. And but yeah, just I mean, there's all kinds of things you can do with data like that. So that's very creative. I love that. Um, so besides CoStar, what are other software tools that you use that you like, not just for capital raising, just for the business in general?
Yeah, you're always going to use a platform to manage your investments and have an investor portal. We actually switched fairly recently, just about 3 months ago, to Appfolio from a company called Syndication Pro and made that transition. All these platforms out there of different strengths and weaknesses. And having been through three now in the last 5 years, I've really seen firsthand all those strengths and weaknesses. And I won't say any more of that. I won't disparage any companies, but that's obviously we live and breathe in there. But we also use a company called Active Campaign. It's really a true CRM system. And that's frankly, it's somewhat new for us too. So we've been doing a lot of work to integrate Appfolio with Active Campaign. And Active Campaign just really helps. Once you start running an investor relations team, a capital raising team, it starts to become more important, right? Hey, how are we assigning new leads that come in just out of the blue? Let's distribute them around. And then having a pipeline, right? And that's what Active Campaign does really well is set up a pipeline. Hey, this person's been not reached out to at all, right? They just here's some contact information. They came through a social media campaign or whatever that is. And alongside that, now we've lined up an SDR, basically a frontline person who is starting to call some of these very cold social media leads. I shouldn't say cold, but people we have no relationship with whatsoever, calling them to set up call appointments with our investor relations team. That part has been a huge help, to be honest. That's a fairly new development. But from my experience, having social media campaigns, you'll get all kinds of leads and they're just garbage, frankly. There's a huge amount of them. And you can call, you'll have their information, you'll call people and they'll say, I don't know what you're talking about. I've never clicked on that. I have no recollection of ever clicking on that. Having an SDR, that person to really screen those people, set up a call is super helpful so I can have my effective investor relations, capital raising people out there, not spending time screening and calling 95-year-old Betty from middle of nowhere, Alabama, who has never touched a computer in her life. And somehow you get some of these garbage leads that come in that way, whether it's a relative clicked on something, who knows? It's been a
Right.
mystery to me. So having a lot of that just, hey, this person's dedicated to making those calls and we're going to bring in the real life people who are interested in real estate to that first introductory call is fantastic.
Yeah. I've been seeing your ads a lot, so I must be on like your retargeting. One of the things that I love doing because I'm a student of advertising and how other student of marketing, and I'm going to recommend this for all of you guys here on listening in. Whenever you see ads of other operators in our industry, you want to click on that because once you click on one of those ads, Facebook is going to show you more of similar ads to that. So I get to see, yeah, everything from real estate to oil and gas to stocks and other things like all like investment type ads. And yeah, it's great to study. So yeah, I've been seeing your company ads quite a bit there, Drew. And I the yeah the Facebook has this type of leads they call it lead form, which is yeah, they click on for more information and then Facebook automatically filled out contact info, and so it makes submitting the information pretty easily. And so that could be the reason why by the time you call them back, I don't remember doing that because Facebook did it for them,
Yeah.
right? So, yeah, so I can imagine that. um in terms of this market coming up, I know in the multifamily space we see challenging with deals. Is that, are you seeing that at all in the industrial space?
We're pretty fortunate to be in this sale-leaseback niche. And there's a lot of dry powder sitting with private equity groups. And so they've been active out there the last 12, 18 months as we've had higher interest rates too. So what's nice is there's still a fair amount of transactional volume. I won't say it's the same. Obviously, it's come down, but it's
Hmm.
interesting. Transactional volume comes down. There's a lot less buyers over the last 18 months. A lot of institutions that we typically compete with they're having a difficult time underwriting for a closing that'll be 4 months out. Interest rates are just no end in sight to
Mm,
raises, or they just have no idea where they're going to be. So a lot of these guys that are a little slower, they're bigger ships, right? They have to go through 3 levels of investment committee. It's more difficult for them to
I
underwrite
see.
deals. And so they become a little more cautious. We've been able to get a lot of deals still that work. And so as a benefit to what we're doing, the investment class and type that we're doing is triple net lease assets with long-term leases, single tenant. Frankly, they're a lot more sensitive to interest rates than something like multifamily. And we've seen that, right? Hey, cap rates are a lot stickier. They have moved, but we've seen them move almost in tandem together. And so we always aim for a spread between, hey, here's our interest rate. Let's say it's 7%. We're aiming for 150 to 200 basis points in spread between there and the cap rate. Hey, it's 6.5%. Okay, we have an 8.5% cap rate here. And you're like, wow, that's anyone who's in the multifamily world day in and day out. It's like, where do I find that 8.5
Yeah.
cap? It's a different asset class. It trades different. And again, there's a lot of inputs there in your pro forma that are baked into that cake, right? There's not a huge amount of value add opportunity, whereas multifamily, you have a lot of different things you can do. So there's a million strategies in multifamily. So for us, we have some strategies to add value, and oftentimes those opportunities will present themselves over time. But frankly, we're a buy and hold team, right? Hey, we're planning on holding this thing for usually 5, 6, 7 years, and we're going to enjoy that cash flow. And the positive here is that if the negative is, hey, I can't add a huge amount of value, the positive is that we're starting at a really healthy cash flow. So our LPs are usually coming in starting at about 8% cash on cash per year. That's really attractive, right? Hey, I have this consistent nature, this more reliable nature of this investment that's starting at a high rate. And cash flow is just going to gradually go up. It's going to go 8.5, then 9. I've seen multifamily deals where it's, hey, there's nothing the first 2 years, and then or the first 12 months, and then you just see it skyrocket. And so it's just a different risk return behavior. So anyway, going back to your question though about the market, is we've been able to sustain that spread and continue to get that day one cash flow. That's really good. Now the really cool part is, hey, we're buying all these at really historically high cap rates. So if rates come down, we have the opportunity to refinance and improve. I said there's not a lot of room to increase that cash on cash, except for if I were refinance each one of these pieces. We're currently have a fund that we're closing up over the next 30 days. That would probably be a portfolio refinance with a single lender, cross collateralized within that fund. And if it's at a 150 basis points lower rate, imagine what that's going to do for
Mm,
investors. It's going to be really attractive. But also, again, as I mentioned, that asset type is more sensitive to interest rates. So if you see that come down, 1.5 points, excuse me, rates come down 1.5 points. There's a huge opportunity for upside for us, having been buying assets over the last 18 months.
I see. You mentioned about private equity firm, which then had me think about family offices. Have you started raising money from family offices?
No, small family offices, yes. The coveted family office that many people raising capital want, hey, if I can get $5, $10 million, 25, 50 million maybe. And it's just a different animal. I find we have moved a bit of our strategy to a fund model. Multifamily offices, in my experience, are less attracted to that. They want these one-off, like opportunistic deals where they can come in, and most
Yeah.
of the time they want to be essentially a JV partner. I always laugh that they say they don't want control, but they do want control. Hey, we want control in writing, but we're not going to put control on it. And you go, that poses a risk for an operator, for
Right.
a sponsor on the deal, right? Because you may find that relationship is tougher at some other future point in time. It starts great. So the control piece we're a lot more protective of, and giving up control to a family office, maybe it does make sense, right? If you have 150 million dollars that says, hey, we'll be basically your JV partner in this fund, that does make sense, right? And you start to go, okay, and you have to establish a lot of trust and a relationship there, of course. But yeah, just to bring in $5, $10 million from someone who wants that control there is not worth it to us. We built this group of private investors who are true limited partners who come in, and there's a lot to be said for having that control and saying, look, we're the only captains of the ship. We're the only decision makers here. And that's really a great thing. If you can preserve that as a sponsor, then you should.
Good to know that. Yeah. Yeah, yeah. I know a lot of raisers, capital raisers in our industry wanting to go after family offices, and it takes a while to build up to the bigger ones, like you mentioned. And then, yeah, and
I've,
go ahead.
I was going to say, I've been to events where, hey, come to this event, network with family offices, and it always feels they're trying to avoid as many managers as they can. It almost feels if you make eye contact with them to introduce yourself, a lot of them look away and try to swim away as fast as they can, and they almost know, hey, I'm the sought after, attractive person in the room that a lot of managers here are vying for my capital, and so they're going to take a defensive posture. And
Mm,
so, in my opinion, the only way to really penetrate that wall is really through a direct referral. So that always is chicken or egg question, right? How do you get your first family office? And it may just be an individual who has friends who manage family offices. That might be the case, right? But
right.
family offices, as well as other institutional capital, they tend to ask, okay, who are your average investors? And they want to be in the place where they belong. And I hear this a lot from pension fund managers as well. Hey, okay, what's your average check size? And if they're an average 25 to $50 million check size, and you're an average $1 million check size or less, they're going to say, okay, we don't belong here, right? I'm sure you're doing great things, but this isn't the space where we're supposed to be. Anyway, it's again, a little chicken or egg thing.
Gotcha. All right, Drew. I know you are a big family man. You have your wife, you have your three young kids there. I'm sure your family's a big part of it. What others reasons besides, or it could include your family too. What's some of the reasons that like get you excited to get up and go to work, raise the next million or the next 10 million, do the next deal?
Yeah, I honestly, I wouldn't even say it's my family. I love what I do because I have flexibility, which affords me time to be able to do things with my family. I get to drive my kids to school in the morning, and a lot of people can't even do that who have a stiff 9 to 5. So I
Mhm.
love those things, but family or no family, I frankly enjoy what we do. We
Mm.
feel like we have a team of entrepreneurs who are all critical thinkers, and it feels so far from a corporate culture. It feels like you really have everyone thinking entrepreneurially and looking at
Mm.
deals differently. And we have debates within our team that go on weeks and weeks about deals, right? And it's fun, it's great, and everyone can voice their opinion. And obviously, we have officially investment committee, which are the principals here. Everyone is really interested and wants to find the best risk adjusted return they can. And even the supporting roles are highly engaged. So I don't know how you preserve that and grow to 5x the time size our team is, but so far so good.
That's good. That's amazing culture to have for sure. That's yeah, that would be another podcast that we can go into, another interview that we can go into just to how the company is structured and how to cultivate that type of culture. All right. All right, Drew, thank you so much. Really appreciate you doing this interview with me.